Good afternoon. It's Chris Robinson, Robinson Ag Marketing with today's post-close grain and livestock comments for December 31st, 2025. Happy New Year's, New Year's Eve day. I'm going to lead off with some data. Just going to repeat this verbatim. Um, Exports, weekly exports. U.S. sold 86.7 million bushels of corn, 36.3 million bushels of beans, 5.4 million bushels of wheat. For the year to date, we have sold a record 1.96 million bushels of corn, up 463 million from last year. However, contrast that with the beans, 974 million bushels. That's down 480 million bushels. So that's really what continues to drive, the soybean price discovery. And the wheat, we sold 731 million bushels, up 115 million bushels. Again, not surprising to see people stepping in and buying wheat when we're at 5-year lows. Most experts agree that China's bought anywhere from 6 to 9 million. They've probably got another 2.5 million metric tons to buy. Are they going to use this break in the soybeans to buy them? I would not be surprised. Again, they promised us 12 million metric tons by the end of February. So we'll see. I would not be surprised to see them step in here. Although we did get any confirmation of any flash sales or anything today. The markets are kind of quiet because of the New Year holiday. The rain's back in the forecast in South America, so that could always change. But at the end of the day, we're going to have a big crop coming out of South America. No two ways about it. I'm going to break down the changes real quick here, starting with March corn. March corn finished the day down a quarter cent at 4.40 and a quarter. Now, a 3-cent trading range in there. Corn was asleep. Beans got basically thrown under the bus. We opened the day at 61, hit a high of 64, then broke to 47, settled at 47 and a half. Went right down. And if you're not getting my letter, sign up for my letter. I'm surprised as anybody, but this damn trend line's come back in. There's a trend line that goes all the way back for a year to December of 2024. And we are dancing on it right here at 47, 44. Is that going to hold, or are we in jeopardy of seeing us go back to the October lows, which was 10.28? So is there another 20 cents to go? Downside risk? We'll find that out probably Friday or Monday. As looks like there was some sell pressure here for sure on a light day, light volume day, crappy. Really kind of a typical Halloween garbage trade. So we'll see what happens on Monday. But at a very, very, I can't stress this enough. Bullish or bearish, you've got a decision point to make here. At this 10.45, 10.44, 10.43 level, there's a big long-term trend line there. I know this stuff seems stupid. I know it seems meaningless. I know it seems odd, but it does do one thing. It gives everybody, bullish or bearish, a single area to focus on. It's like one down of football. You've got, we're first and goal. Is that line going to hold? I don't know, but manage your risk accordingly. That's all I can say. I'm personally surprised that we dipped down here this last day. I expected a sleepier trade. So shame on me, right? All right, so March wheat down 3.75 cents, traded as low as 5.06. So bottom line is, if March wheat takes out the contract low, we're going to have, headlines about, March wheat with a 4 handle. So defend what you can and hold on. In the protein complex, real quick, a little green on the screen there. Fed fat cattle finished up 1.125, traded as high as 232.45, settled at 231.60. Fed fat cattle still have a way to go, though, to go fill that gap. There's a gap in fed fat cattle at 233.42. Today's high, 230.95. So is there another 2 cents to go? I don't know. At the end of the day, I look at it as this. We had a tremendous sell-off from 250 down to 204, right? We've managed to claw back a big amount of that. We have not filled that gap in yet, but as despicable as it is and disappointing as it is to watch the beans get hammered and corn kind of sit there trying to figure out if it's going to break a rally. The lone bright star is this rally in cattle. Look at feeder cattle. We filled the gap yesterday in March at 345.05. We traded as high today at 346.30. Why is 346.30 a big one? Well, anybody that's been following my letter, and I've been writing this letter in one way, shape, or form, God, for, at least 15, 16 years. I started writing it after I left the floor in 2010. 345. Why is that a big number? 345.30. It's the 62% retracement of the Swan Dive. We went from 378 to 293. Why do these levels matter? I don't know, but we knew this was a possibility ever since we had that low at 293. All it was a basic Fibonacci retracement, and lo and behold, we've gone from November 25th to, in 6 weeks, we clawed back 62%. I don't think that's an accident. If you are a trader, if you are a producer, if you are not watching these levels, I think you're making a mistake. They are not infallible, but they do serve as really good targets. And it's one thing I do every day in the letter. I break it down every day. You don't have to do it. When I was on the floor, I would do this stuff when I was riding in the train in the morning before I got to work. I would Xerox it. Remember Xerox machines? I would Xerox it and hand it off to 4 or 5 of my friends so we'd have the levels to watch during the day. They are key levels. And again, are they the goose that laid the golden egg? No, absolutely not. You still have to make a decision of how you're going to manage your risk. It does help you pick levels, though, but it doesn't take away your responsibility for managing your risk. Moving over to the lean hogs, the same idea. We dropped from 94.70 to 81 even. That was a 9-month low, right? When we dipped down lower, we've clawed back 62% of it. We're north of that 62% retracement. Now it's like, okay, it's kind of like those old Wile E. Coyote cartoons. We've run. We're out over this level now. Is that level going to hold? Are we going to go back up to 94? Are we going to roll back over and go back to 82? I don't know. Nobody knows. That is why we hedge. Okay? And I mentioned this today when I was on RFD TV with Tony and Scott, the cow guy. Um, People always say, oh, hedging. All you talk about is puts. Yeah, puts are there because if you're a producer, you're always bet long. You're like a one-armed speculator, right? You get in trouble if the market goes against you. But, a hedge can be a call option as well. And when we dipped down there sub $3 in feeder cattle, I had some guys call me up that did not work with me that were, angry because they hadn't been hedged. They just watched the market drop $85, and they were selling into that low. And at the time, I was like, well, I guess what would book you make you bad? If you sell it here and it keeps going lower, great. You stop the bleeding. If you sell it here and then it rallies $50 like it did, little did I know that it was going to do that, because trust me, I would have gone out and bought, as the position limit in cattle, and had a down payment to buy an NFL team. I didn't know we were going to rally $50. The suggested hedge at the time was, if you were selling animals down here and wanted to reown them, go spend $1 or $2. And that turned out to be the upside hedge. So just want to leave you on that note. People say, a hedge is a hedge. All it is a way to manage your risk. And the reason I like using long options for 99% of guys out there is you don't get run over if the market moves against you. And I'll leave you with this example, and then I'll cut it up for the day. When we bottomed out last time around 57, 55 and started the rally in the beans, I suggested that anybody said, hey, after a $1.15 break, look at cheap calls. For a lot of guys, we spent 10 cents on calls. Now what's happened? Well, the market's dropped through that low. We still have the position on. Probably that original 10-cent option is worth maybe 3 or 4 cents now, maybe less. But you're not making any margin calls. You're not getting run over. And I can tell you this, depending on where we are between now and January 11th, when that report comes out, we'll take a second look and say, hey, we spent $10, we spent 10 cents on these calls originally. They're worth whatever they are today. Maybe they're worth 9 cents. Maybe they're worth a penny. I don't know. But if you want to reload, it lets you to do that. So you're getting a defined risk, as opposed to, if you bought futures and then we dropped 30 cents. I mean, That's the difference. If you got long with calls, you locked in your max loss the day you bought it at 10 cents, it's probably still worth 2, 3, 4 cents. But if you bought futures, um, you set through a 30 cent pullback. So that's the difference. That's why I try to hedge with options always, because you don't need more risk. If you're a farmer or producer, you don't need to add risk to an already risky deal. Using the options, again, they're not perfect. Uh, don't have to school me on how options are different than futures. But the one positive thing about using options is, in my opinion, is you have a defined risk. Sometimes you have a defined reward, but if you do it right, you have a defined risk with an unlimited award. Or you get in trouble with options if you start selling and collecting premium. That's a whole nother ball of wax. And you can end up with some problems on your hands if you're not managing that. So at the end of the day, if we knew exactly where prices were going to go, we wouldn't be in business, right? We would just let AI do it or let some computer program do it. As long as markets are ruled by emotions and you see the type of nonsense and emotions, that's especially perfect example. Look at silver, just all over the place in the past 6 to 7 days. Tremendous moves, tremendous volatility in silver. And limit moves here in silver. It goes 7%, 10%, 15%, 20% in the silver all day long. Marching silver right now, today alone, a $7 range from 76 to 69. And as I'm sitting there right now, it's right back up to 70. So options using in silver can be a little bit spendy, but the same idea remains the same. If you're trading futures outright, even if you're trading the micro futures, every dollar is $1,000 as it's 1,000 ounces. If you're trading the full contract, every dollar moves 5 grand because it's 5,000 ounces. So it can be very rewarding, but very risky. All right, on that note, Happy New Year, everybody. We'll be back at it Friday morning, bright and early. We have a full day Friday. This is Chris Robinson. If you're not getting my letter, go to robinsonagmarketing.com. If you just want to talk about your marketing, maybe you're working with another broker, you want some more information. I have guys that, they look at my levels, they use my levels. I do the homework for them, and then they use the broker of their choice. Some guys do it themselves. Some guys don't trade at all. But if you're looking for key levels, especially if you're looking to try to make better cash sales, take a look at my program. I've been doing this in one way, shape, or form for over 30 years. I spent 20 years on the floor trading my own account. I did not have any clients. I did not answer to anybody. I had a couple of employees. And then in 2009, 2010, the floor basically disappeared, right? We stopped being necessary. The order flow all went to the screen. So price discovery went to the screen. And luckily at the time, it was painful, but I was able to make a transition to working with farmers, clients, end users. And so if you're looking for that type of help, for that type of experience, give me a call, 312-638-8868. Have a great holiday. God bless everybody, and we'll see you Friday.